Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsandMarkets.com runs down the major markets. He points out most of the major sectors are at or have set record highs. Gold had an interesting week, crude was flat, and uranium had a glowing report. Ross also has a special offer for our listeners. CEO of InsideTrackTrading.com, Eric Hadik, gives the inside on the cycles that concern gold, silver, the US dollar, and several other currencies, and even Bitcoin. Author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, tells us the real rate of inflation depends on what you spend your money on. He talks about the crashing Toronto condo market, the dread of facing a mortgage renewal in Canada, and being a longtime Tesla owner, Hilliard will also chat about the EV market. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always a pleasure, Jim.
Ross, do we have a special offer for our listeners?
Yeah, for new subscribers, 25% off the annual subscription. So right on the front page of the website, which is chartsandmarkets.com. There's a selection there. And also, Bob has a list of some of the junior miners that he's been looking at the last 6 months or so. And there's a spot up there on the front page. You can just select the button there and pull down some of the junior names.
Ross, how would you describe what happened on the stock markets this week?
Well, as always, we've got our fluctuations, and everybody has been waiting for the Fed and Powell to come out of Jackson Hole with some commentary. So, surprise, surprise, the Fed is finally now ready to lower rates. The question will be, I love it. So there might be 4 rate cuts before the end of the year, but there's only 3 meetings. So what does that mean? We got one big one, a 5, a 25, and maybe a 50 here or there. But anyway, the announcement mid-morning on Friday that the Fed is ready to start lowering rates, and with that, equity markets on the move. And really, this is an across-the-board one. If I take a look, 2-3 months ago, leadership was just rotating one area after another. We had, the Magnificent Seven had been the big names for a while. Then they backed off a bit. But gosh, when I look down right now, the staples, the industrials, the financials, materials, utilities, the REITs, healthcare, biotech, they are all at or through all-time highs right now. So this movement by the Fed, which is really, as always, the Fed catching up to what the open market has already been pricing in. I'm surprised that we saw as much action on Friday, but the fact is that we're in still one of, the better months of the year, July, August, but September, October, one has to be very wary about. So, we've clearly, 9 consecutive days, or 8 out of 9 days have been on the upside, starting to get a little pricey. So, don't be at all surprised when things decide to roll over and come back down again. We're just seeing once more a bunch of excesses on the daily charts.
What's going on with gold?
Been a interesting week there. We had some really good readings on the upside for gold into the middle of the week, looking for a correction. We had been up around 25.30 on the spot price, pulled back just to test the July, early August highs, and have held there. I'm looking at that. The low that we had on Thursday is very, very important for the gold and the silver market. They say at the point here where I think they either accelerate or roll over and have a pretty deep correction. So, once again, this is a market where August is usually the second best month of the year for gold. And on the other end of the coin, September and October are the two poorest months of the year. So, definitely look to have some tight stops. We have recommended taking some money off the table on the miners. The last 6 weeks have just been a great run on some of the big names, the Agnico Eagles, the Barracks, Alamos. They've just had some really nice plays. But it appears prudent to have taken a little bit of money off the table.
What's going on with crude?
There's one that really hasn't done too much. We were starting to move into new lows for the year, got down to $72, bounced back at the tail end of the week, but seasonally we're in the heart of the negative stretch here, so resistance appears to still be maybe around the $76 to $77 level, but trend is down for now, and I don't see any real bottoming indications as of yet. So the complex, including heating oil and gasoline, probably looking at the same thing. Markets that are going to stay under pressure for a while here.
What's happening with the U.S. dollar?
We are right on schedule here for our cyclical low. It tends to run 58, 59 days between lows for the last couple of years. This coming week is right into that window that you would expect to see a low, and prices have really come off here. We're at par 0.67 as of the end of the week. 10 days ago, we were 103.5. 2 months before that, we were up at 106. So this has really, really been a tough stretch on the downside, but right in line with the way that cycle is playing out. The excesses that we've got on things like the relative strength and the exhaustion index are such that we haven't seen since back in January, which is when we ended up with that rally that carried us from 101 all the way up to 106.5. And you got to go back to 2021 to find result readings that are once again at this level, and that became a very significant move on the upside. So typically you want to be looking at the 20-day moving average as resistance. Probably get up and kiss that one on the first bounce, and if it manages to push through that after a couple of tests, then look for a decent move on the upside. With a cycle being that 58 days, we're going to expect a good 20, 25 days of price action minimum on the upside once this thing turns. And with that, the other side of the coin is that so many items that are viewed in U.S. dollars, i.e. gold, silver, crude oil, that'll put a lid on the top of those ones. So, we'll be looking for some key reversals pretty much across the board.
What's going on with the little old Canuck buck?
Canuck buck, as we've mentioned for the last month, has had just really, really high commitment of traders' data numbers. The speculators have been just short record amounts. The commercials have been long record amounts of the futures contracts. And this week, Canadian dollar just had a really good move. It broke out through resistance levels. We're at just over 74 US. We haven't seen that kind of a level since back in March. It's not just the Canadian dollar. It's the euro. You take a look at the euro. Best levels that we've had in the euro going back till January of 2022. You look at the Mexican peso. It's even bounced off its lows. The Japanese yen has had just a phenomenal move here since the middle of June, probably getting up into more of a stratosphere right now in terms of pricing. So all the currencies looking to be, like the gold and silver markets we mentioned, getting towards levels of excess, and you want to be very, very careful about positions there. That Canadian dollar, I think, if we see the commitment of traders numbers in the next week or 10 days come off significantly, that would be enough to help us put in a top here. The other area, I guess, of significance has been uranium. Just a big week here to finish off. We talked a couple of weeks ago about the important oversold levels in terms of the uranium price itself. It had backed off against the 50-week moving average and had some good short-term oversold readings, some sequential signals. And the big names, some of them, the Chemico and Denison's and NextGen, all gave some great oversold readings. They were up 1 or 2% last week. A great move on Friday for most of these, as the one of the major Russian producers there, looks as though it will have to cut back on production. And with that, we've got this good spurt in these ones. I think that you can be looking at a good 38 to 50% retracement rally on the uranium stocks. So this has started off as a pretty nice trade coming off the bottom. I think there's still some legs left on the upside.
Ross, thank you so much for chatting with us. And can you tell people again how to get your special offer?
Go to the website, chartsandmarkets.com, and it's right there on the front page.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Eric Hadik next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. Welcome back to This Week in Money.
Oh, thanks for having me back, Jim.
Eric, can you tell us a little bit about Inside Track Trading?
Inside Track Trading is a financial, market advisory and trading service. Our primary products are subscription-based newsletters and update services. I take a technical and cyclical approach to analyzing and trading the markets. And my focus started out with a core of the futures market, but it expands well beyond that to many related markets and sectors that most people are involved with.
Does it look like natural gas could have put in a bottom earlier this month?
I have been looking for a bottom in the energy markets in the third quarter. And natural gas, when it triggered its most recent sell signal in June, part of the factors leading into that was a consistent 8-week cycle progression that it had been following. And that projected a drop into the first part of August, which we have seen, as you alluded to. And so natural gas certainly fulfilled that downside, but at that point, I need to see price action start to kick in and validate those cycles and cycle progressions. So there is certainly reason to believe we're in the time for a multi-month and perhaps larger magnitude bottom in natural gas. And on a daily basis, it gave a couple of signals that start to indicate that a multi-week low is in place. But there's still more work for it to do before I would be convinced that we've set a major bottom and are starting on a larger degree uptrend. And one of the things, even though they don't trade in lockstep, they're often almost 180 degrees opposed sometimes. The other energy markets, the oil and gas markets, unleaded gas, they have been showing me for quite some time that they should decline into September. There's a large or significant convergence of weekly and monthly cycles that I'm looking at in September for crude oil, unleaded gas, heating oil. And so it's possible that if we get any additional factors that maybe drive a final spike low in those energy markets, that maybe natural gas has an additional spike low kind of in sympathy with them. It could be anything fundamental or technical. You could get even if things start to look a little more calm in the Middle East, you might get an additional spike low in the energy markets, which would fit with these cycles that have already been focusing on September. So it's often fundamental events that come to the surface and validate those cycles. So that's what I'm looking at in the whole energy complex. Bottom line is I think we are near a major low, but from a price perspective, particularly where crude and the other energy markets are concerned, they're still honing the downside final targets for this decline.
The Dow, S&P 500, NASDAQ, and Russell 2000 all pulled back and have been recovering. What are you seeing in the stock market cycle?
I would start out by answering that with kind of reviewing what I have discussed multiple times from a broader perspective. And I would emphasize that broader because it's large scale enough that it's not something I would recommend trading off of. It's more of a backdrop for what I'm watching. But coming into this year, I just started reiterating something that I discussed in great detail back in 2006 and 2007. And that was this uncanny 17-year cycle in the overall stock market that has timed major tops, very significant sell-offs, minimum of 20%, and many of those instances going back over the last century have been 30 to 50% sell-offs. We got exactly that following the 2007 peak, which came exactly 17 years from the 1990 peak, which came 17 years from the 1973 peak, and the 56 peak, and the 39 peak. So it's something that has just continued to unfold with very consistent regularity. And it's what I have been expecting for 2024, 2025 was a major peak in 2024 and a sell-off into at least 2025, possibly stretching into 2026. Then narrowing down that focus a little bit, I discussed how there have been some parallels, some analogs to those previous culminations of the 17-year cycle. And if you look back at the last three instances, in each case, there was a very significant peak in July of 2007, 1990, 1973. They were different magnitude peaks, In '07, it was the penultimate peak right before the final peak in October, although many of the markets simply went back and retested that July high in October. In 1990, it was the ultimate peak before a 20+% sell-off. And in '73, it was a secondary peak. The final peak was already in place, but it was the peak that took hold before the sharpest sell-off unfolded. So you had kind of that analog that I was discussing leading into this year and continued to focus on July of 2024 as being the time for a very significant peak in the markets. Prior to that, I thought we would see an initial high in the first quarter, a March-April sell-off, then a second higher high in July, a July-August sell-off, and then I do think we'll see an October peak, but that has not been determined by all of my other technical indicators whether I think it will be a higher high or a lower high. So there is a chance that July already set this peak, but I would need to see more confirmation before I would be very strongly convicted in that direction. The markets moved pretty much in lockstep with what we're describing in our weekly relay and the sell signals that were generated particularly in just before mid-July in the NASDAQ 100, and all of that was projecting a sharp sell-off into August and down to some key price targets, many of which were hit. One of the most kind of uncanny leading stock that I know I've discussed with you a couple times, but was this AI stock of NVIDIA, and how it has really led so much of the market swings this year. So I certainly pay attention to some of the cycles and technical levels in that stock. And so in late June, I was describing why I thought that it would peak right around 140 and drop to at least 96 from there. That was all published in late June, and it ended up peaking on June 20th at 140.76, sold off for a week or so, then rebounded to a lower high just as the NASDAQ 100 was diverging and setting a higher high around July 11th. And then both of those, the index and the stock, triggered more significant sell signals. And where did that stock plunge to? But right down to 96, spiked below it for a couple of hours in early August, and then put in a multi-week bottom. So you had a lot of corroborating factors saying that the stock indexes had reached initial downside targets, but there are certainly some indexes and some trend indicators I use that are showing me that might not be the final sell-off for this phase of the market. And the Russell 2000 is one I came into this week describing why I thought it had the most consistent and tightly grouped convergence of upside targets and resistance levels coming into play roughly between 2180 and 2200 in the September futures. And that's where I thought we would see an intra-week peak. And on Tuesday, we got it spiking above 2180 and immediately selling off. And then today it has just spiked again above 2180 and is turning back down. So the Russell seems to be corroborating that outlook, and that index in particular is showing that there could be lower lows to come out during the next intermediate cycle low.
Gold's hitting new highs over $2,500. Does it look like the gold cycle has legs?
I've been talking about gold coming into a pretty significant top here in the third quarter of 2024. So I think we might be coming to the culmination of this phase of gold's bull market. I still think that there is another year or two of overall upside, so it's not that I'm projecting some sort of major top here, but many of the indicators I use are telling me that rather than having legs, that this part of the bull market is starting to, the legs are getting a little shaky and they need a bit of a rest. And even from a wave structure, gold is tracing out a very textbook fifth wave advance from the October 2023 low, and that the fifth wave of that five-wave advance, began in early May or early June, whichever one you time as the fourth wave low. And gold is showing a lot of signs that it is reaching the upside potential for that fifth wave advance. So while it hasn't yet confirmed a major top and hasn't yet shown that there is no chance of additional spike highs, this week's spike up to 25.70 in the December gold futures reached a lot of additional targets and resistance points and could trigger a bit more significant correction than we've seen in the past few months. With that said, I've been talking all along that silver and the XAU index could extend, or really should extend, their latest rallies into September. So I'm kind of watching close to see if there's some divergence at a potential high in September where silver might be the one with more legs to it leading into there and gold is lagging a bit, or whether gold stretches this fifth wave and these cycles into a higher high in September. So there's a lot of specific price action and technical indicators that need to hone that outlook and get it more to a precise timing and level for a top.
How is the silver cycle looking?
Well, like I said, silver is really when it pulled back into early August, silver was fulfilling much of what was expected for a corrective period. It had topped in May, whereas gold continued to set higher highs in June and July. That's the same type of divergence, but in the opposite manner that I was just alluding to with gold in September. I think that silver is entering the time when some of the fundamental factors are coming together to create another, what I call, sweet spot for silver. And I've described that a couple times in the past, where there are these time frames and these phases within the precious metals bull market where some of the fundamental factors are aligned just right for silver. And one of those was in February through May of this year. And I think we could be coming into another. But some of that has to do with the interest rate inflation battle, and that it's pretty clear that interest rates are going to start coming down. And so that is really removing the biggest impediment to silver's rallies, that the one thing that holds the prices of gold and silver in check during any sort of inflationary market is the threat of higher interest rates. Well, that threat has been removed for quite some time. When it really started to be perceived that it was off the table, any additional rate hikes, that was when silver really surged into May. But you're coming into another phase where I think you're going to get the manifestation of those expectations. You'll get most likely an interest rate cut in September. But I think that inflation is, particularly from a commodity price inflation standpoint, that it could be putting in a bottom in September. And that is based on several different markets, including the energy market, but also things like the Goldman Sachs Commodity Index, that many of these indicators, markets, and indexes are showing that September could be a significant bottom. And if that's the case, it could be saying that there's a new phase of commodity price inflation on the horizon. And if and when that's true and becomes a little more apparent to traders, that would be another impetus for silver to start moving higher. So I think that it is, from a structural standpoint, from a wave perspective, it had a very clear ABC wave correction from May through August, and it came right back to major support that has actually alternated between resistance and support over the last few years, right around 2650 in silver. And this time it was expected to be support on the way back down. And there were some key trending indicators that I use and that I was describing in my newsletters that showed me that should be a bottom in silver, and it's time for it to start entering into a new phase. And that doesn't mean that all of a sudden it explodes to the upside. There's a couple of specific times when that appears like it'll be more likely based on some price timing indicators that I use in sync with each other. But it does show that most likely the bottom for the latest correction is intact and that a new advance is in its infancy.
Does the U.S. dollar cycle look like it's bottoming?
I think on an intermediate basis, you're going to see a bottom in the dollar right here. And that's based as much on price action as anything else. I do think that the dollar, from a broader perspective, has entered a very negative cycle and negative phase. But on an intermediate basis, my outlook was for the dollar index, and I'm focused on the September futures, but would drop below 101 this week and likely set a short-term bottom there. And just yesterday, we saw it spike down to 100.78, I believe was the low. And when that happens midweek, it's often a good time for an intra-week low. And so I'm looking to see if the dollar index can get back above 102 and start to signal that an intermediate low is in place. But I haven't seen any of that yet, so I have to respect the trend, which is down on a 2 to 4 week basis, on a 2 to 4 month basis, and I think becoming negative even on a 1 to 2 year basis, particularly leading into the end of August, when I think that the dollar index could generate one of the most negative technical signals that I follow, and that would confirm several multi-year indicators turning to the downside. And again, that doesn't mean that suddenly a collapse is right on the horizon or right around the corner, but it's a strong confirmation that the top that's already intact and the secondary top that's already intact are very unlikely to be retested, and that the dollar is starting to focus on the future times when it could see sharper sell-offs based on technical and fundamental factors.
Where is the Canadian dollar in its cycle?
The Canadian dollar is one that I kind of keep a secondary focus. No offense to any of your Canadian listeners. But I am very intrigued by about a 4.25 year cycle progression and an overarching 8.25 to 8.5 year cycle progression. And both of them were telling me to look for a 1 to 2 year bottom in the middle part of 2024, anywhere from March, April through July, August. And we saw an initial low in April, which very precisely fulfilled those cycle progressions. But then when it rallied, it was not able to turn its weekly trend up. And when I get a signal like that, that's a very key technical indicator for me to either confirm a bottom or to tell me the bottom's not in yet. And I explained to my Inside Track readers why I thought the Canadian dollar could see another dip into July, into late July. And we saw that it fulfilled some additional indicators to the downside and set up the stage for that bottom to take hold. I also like the fact that it didn't close below the previous low. So in effect, that April low is still a very significant cycle time frame and could easily be the lowest monthly close if the Canadian dollar continues to rebound as it has the last couple of weeks. There's a key level I'm watching this week on the August 23rd weekly close that if the Canadian dollar can close above that level, it would turn my weekly trend up, and that's a lagging / confirming indicator. But what it does for me is it validates the previous low, tells me, yes, that low should now hold not just for a few weeks, but for at least a few months. And paradoxically, that signal often occurs near an initial high. So kind of the first wave high of a developing advance will often occur right after that weekly trend indicator has been triggered. So if we see that happen on Friday, then I would expect to see the Canadian dollar put in a short-term top, maybe up around the 73 level, 73.80 level, and then see a pullback perhaps into September. And maybe that's something that's linked to what I was talking about with the energy markets, since there's sometimes a loose correlation there, sometimes a stronger correlation there. But if energy markets just saw this quick spike low, that might be something that pulls the Canadian dollar back a little bit, and that would be if it holds certain support levels and the same weekly trend indicator that's now looking for support, that would be the ideal scenario for when to enter new long positions and when to get more bullish on the overall outlook for the Canadian dollar. So I think that potential is definitely on the table. It's shaping up key levels both on the upside and downside for a correction at the very end of August or early September. But then I think around mid-September is when you would probably get the ideal opportunity if all these indicators play out the way they normally do. Then that would be probably the best or the ideal. And when I use the term ideal, I'm talking about the greatest synergy of price and timing indicators coming together. Ideal scenario for a secondary bottom and the onset of a stronger rally in the Canadian dollar.
Is the Japanese yen in a cycle?
There's some very interesting correlations between the Japanese yen and the Nikkei stock index in Japan to that same 17-year cycle that I described in U.S. markets. And I've been writing about that all year in Inside Track and explaining why I thought, first off, that the Nikkei was due for a major top in 2024, and why I thought that the yen could see a major bottom in the middle part of 2024. The Nikkei fulfilled that expectation, saw about a 25% drop in July and August, so a strong confirmation to that analysis. And at the same time, the yen put in a bottom that was not only linked to this 17-year cycle very closely, but it was also linked to the pricing of where it had previously bottomed on that 17-year cycle basis. And so it set a major bottom in the second quarter of 2007, and prior to that, it had set a major bottom in 1990, right around 62.50. And that is where the yen came back down this year to two 17-year cycles from that 1990 bottom, and where it set a major low. And I think that the yen is just in the very early stages of a new bull market, although it has exhausted a lot of its upside potential for the initial phase of that. So I do think that we're into a time frame where a lot of currencies are seeing a shift and are preparing for a much bigger shift out on a 1 to 2 year time horizon. And that fits with some of the expectations I have for the U.S. dollar, that it could be a very precarious time for the U.S. dollar in 2025 and 2026.
Is the euro cycle signaling any highs in here?
Yeah, on a short to intermediate term basis, but again, I go back to some of the key price indicators that I follow, that cycles act as a backdrop, and they certainly identify what time frames are important for me to be monitoring, but it's the price action that really ultimately validates that. And the euro, I was expecting it to run back up to its year opening high. So basically the January peak, which in the September euro futures was right around 111.50, I thought that would be the first testing point for the euro. So it first needed to make it up there. And then the first important point is whether it can give a weekly close above that level. It did just shoot up and gave a close at 111.75 yesterday. But again, I'm more focused on Friday's close and whether that is above or below. That will be an additional indicator, but a lot of what I'm looking at is telling me that this could be the culmination of a 1 to 2 month rally in the euro, and that it probably needs to see some consolidation before a more sustained advance takes hold.
Backed by nothing but greed, Bitcoin has its own cycle. How is the Bitcoin cycle looking?
Well, I would go back to what I've discussed since the first quarter of this year, and for the year and a quarter leading into that, I was explaining why I thought Bitcoin cycles were positive and should be spurring an overall rally into February or March of 2024. That is a very consistent 16-month cycle for Bitcoin and Ether. And everything was saying to me that Bitcoin needed to spike to new highs and probably put in a 3 to 6 month or 6 to 12 month top in March of 2024. And so that's what we have seen. It has consistently validated that. And my outlook from there, looking forward from there, is number one, the next phase of that 16-month cycle is in the second half of 2025, which certainly should be another important peak. But in between, you often see at least a 6 to 8 month decline, and could be as much as a 10, 11 month decline based on that one particular 16-month cycle. There's a lot of other factors. That's just one thing being incorporated into the overall outlook. But Bitcoin turned its weekly trend down, and it has been showing me that it probably has another leg down. It could take it down to the $40,000 to $45,000 level before major support is encountered. And there are a couple of key cycles, one in September and one in November, that I'm watching for future lows in Bitcoin. And it's going to be the price action and some of my key indicators that hone that outlook and tell me where precisely I think it could reach and when those bottoms are most likely.
Expectations are that the Bank of Canada and the Fed will lower interest rates over the next month. Is that what the cycles are seeing?
Well, I certainly think that everything that bonds and notes and other interest rate vehicles have been showing and anticipating, even things like a 4-year cycle that I've described in interest rates and in bonds, are all showing that that's certainly a high likelihood. And, basically they now say that economists have, priced in 100% chance of at least a quarter point drop by the Fed. So it's no surprise or no great epiphany that it looks like rates are going to come down a bit. But what's more intriguing to me is looking beyond that initial interest rate cut, whether that's a one and done or whether it's the start of a rate cutting cycle. That's the more intriguing thing to me, and I've been starting to discuss that in Inside Track and laying out some key time frames when I think we'll see future lows and highs in bonds, which would correspond to future highs in interest rates. And when I say that, I mean after you get the initial perception of rates dropping, and the implicit rates, not just what the Fed is doing, but what the market is setting interest rates at, and then you get a rebound from there. That's the high I'm talking about, a secondary high. But then when I think there is a greater likelihood for a more significant low in interest rates, so certainly showing that there should be another rate cutting cycle out in 2025. But again, the question is what the perception will be immediately after the expected September rate cut. And bonds and some other markets are starting to give a few clues to that, but it's much more important what they're doing and what they're showing in the 1 to 2 weeks that are leading up to that time frame. You often get markets turning on a fundamental factor like that and turning in the direction that a lot of novice traders don't really expect. And so, you could get a cut in interest rates and that be a top in bonds, which normally, logic would say, if rates are going down, bonds should go up, except bonds have already priced it all in. So once you get that fundamental factor, that's when there's nothing left to move the market higher, bonds, which trade inversely to interest rates, and when they can be in store for a little sharper setback. So it's certainly almost a given that rates are going to come down a little bit, but I think there's a lot of complications out there on the horizon that are going to keep traders and economists guessing where each interest rate potential cut is involved, where each Fed meeting is evolving, and that 6-week cycle. So it's going to be something that really needs to be monitored very closely in the days and weeks leading into those Fed meetings and those perceived or expected rate changes.
Where can our listeners follow you and subscribe to Inside Track?
They can go right to our primary website at InsideTrackTrading.com, and that is inside with the extra I in the middle, so it's INSIIDE TrackTrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim. It's been my pleasure.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to This Week in Money.
Thank you for inviting me.
Can you tell us about the second edition of When the Bubble Bursts?
Well, so the second edition came out in 2018, and it's a review of what I learned from the first edition and everything leading up to the changes that happened in the housing bubble during that time. And I expanded dramatically the explanation of the economic situation that allows bubbles to form and why they eventually must burst. So it's an excellent addition to the first edition, and goes further and deeper into the why, not just the fact that we had a massive bubble and existing in Canada. Still available in stores. Actually, both editions are still in print, which is kind of a positive, I guess, when you think about it. And there's still some interest. And now with the housing markets finally starting to correct in Canada, especially in Toronto, in the condo segment, seems to be a renewed interest in the book.
Stock markets dropped recently. The Dow down almost 10%, the S&P 500 7%, the Nasdaq down 17%. Since then, the markets have been recovering. Do you think this drop was just a pullback in an ongoing bull market?
You know, it might be. The bull market is going to end at some point, and every one of these dips that we see is examined closely to see, well, is this the end of the bull market? And there's no way to know. There was one clue, though, that I wrote about in my weekend note, which everybody's free to subscribe for. Just watch for it to come out and then click on the subscription button. The first instance of it is when it shows up on X, or formerly Twitter. So what I found in my research was that the Magnificent Seven, the seven large companies that most people know about that are leading this bull market, dropped dramatically in that correction we had about a week and a half ago. But the Russell 2000 also dropped by about the same amount from the Thursday night to the Monday morning. So that indicates that it isn't just the Mag 7. There's something else going on there, which is very interesting and kind of confirms maybe that there is a crack opening in this market. The headline reason given for the correction was the carry trade, where people borrowed money in Japan at cheap interest rates and invested in the U.S. stock market, especially the big seven companies, had blown up because interest rates that were rising in Japan and the currency was rising, and that would make it more expensive to repay those loans. But it's unlikely that it was just that one thing, and I think it was a broader thing. But as your question indicates, the market has recovered from that sell-off, and now we're within a 1% or so of all-time highs. So there's no evidence yet, no confirmation of the end of this bull market, but it will end at some point.
Gold is over $2,500 this week, hitting new all-time highs. What do you see ahead for that?
So the price of gold has done extremely well since the global financial crisis of 2008, 2009. Gold has been doing extremely well. It's triple what it was at the peak in 1980, in February 1980, which was 800 and change. But if you do an inflation adjustment on that number, you actually get something north of 3,000. So inflation adjusted, it still hasn't gotten back to its peak. It's got lots of room to grow if the U.S. dollar is weak. So it's basically another way of saying the U.S. dollar is, if the gold is going up, the U.S. dollar is going down, and because it's measured in U.S. dollars. So, but I do think with all the central bank buying that's been going on and the renewed interest in speculation, the price of gold would be headed higher for a while longer, as long as interest rates don't go higher, and it looks like interest rates are going to go lower, so that'll help the price of gold. But the real bargain is in the companies that mine gold. They've finally started to move, but they are way, way behind the price of gold. Owning shares in mining companies is much more profitable based on the cheapness of the investment. So that's what I prefer to do, and there's a bunch of them that are have been moving up lately, but they're still got a long way to go, just even to catch up to the current gold price. They've been lagging for more than a decade.
The U.S. dollar has had a significant pullback since the beginning of May. Are you bullish on the U.S. dollar?
So the U.S. dollar is a function of what people think about the U.S. deficit, the U.S. debt, and also the interest rates that the U.S. government bonds offer, and they're extremely generous. Like right now, for example, the 10-year Canadian bond only yields 3%, and the U.S. 10-year bond is yielding 3.8% or roughly. And that's a big premium when you consider that you need to have a pretty big change in the currencies for that amount of income to be erased. So I would think that the U.S. dollar is probably going to get stronger. I don't think it's going to get a lot weaker unless people get worried about the deficit. And the deficit is absolutely enormous. I think you and I talked about it maybe last time we talked. We're looking at over $2 trillion deficit. It's around 7% of the GDP in the economy, which is just absolutely staggering amount. And so what the election in November, whoever wins is going to have to deal with that. Now, the Kamala administration would be more likely to try and raise taxes and also spending, and not really do much with balancing the budget. So the deficit is likely to continue. And the Trump administration, if that gets in, is likely to cut taxes, especially on the wealthy and the corporations, and that's going to increase the deficit as well. So neither one is showing any signs of doing anything about the deficit. And as long as people are willing to buy the government bonds in the U.S., they can keep selling more government bonds, keep printing more money, and the U.S. dollar won't tank because it still is a reserve currency. So it might last another 5 or 10 years, and it might end tomorrow. It just depends on people's view of how strong that U.S. currency is. But the interest rates are really attractive, so that keeps a steady flow of money going into the U.S. dollar.
Do you think gold in the U.S. dollar could be indicating where inflation and interest rates are headed?
Well, the strength in gold for sure is a couple of things. So basically, we talked about that 3.8% yield on U.S. Treasury. So let's round it up. Say it costs you 4% roughly to own gold, because you're not getting the interest on that you would if you bought the bond instead of gold. So you got to think that gold is going to go up 4% a year, or the U.S. dollar is going to go down by 4% a year to give up that interest payment. But if the U.S. government, and they're going to start cutting rates in September, if the U.S. government Federal Reserve cuts rates too aggressively, gold will go higher, the U.S. dollar will go lower, and it'll be a very interesting situation. If they raise rates, and they're unlikely to do that unless there's some major crisis or the economy's extremely strong, then gold would get hit. So I think it's a sign that the market, the strength in gold is a sign that the market believes that rates are coming down, and the government's going to live with some inflation, which is gold's always a good safety valve if you're worried about that outcome.
What do you think the real rate of inflation is in Canada versus the official rate?
Yeah, so the rate of inflation for everybody is different, right? So it depends on what you spend your money on. So there's no real official true rate of inflation. The current method they have, which they adopted in the early 80s, had to deal with the housing market in a very complicated, convoluted way. And so for a long time, the rate of inflation was vastly understated. We had a long period when inflation was under 2%, but house prices were going up by 7%. The shelter index is 30 or 40% of the inflation index, depending on which one you use. So it was mathematically impossible for inflation to stay below 2% in a housing market that was rising by 7%. But they managed to find a way to calculate it that was the outcome. So now that the housing prices have leveled off and started to come down, it's not going to show up in the index right away. And that's the latest numbers on inflation have been very, very good. If you like low inflation, most people do. But the one segment that's been still too high has been the shelter, what they call shelter, in both the U.S. and Canada. So when that comes down, inflation will come down, and most people, depending on who you are and where you are in your life cycle, the cost of shelter might not be a factor at all. If you've got a long-term rental that the landlord wants to keep you there and doesn't raise your rents, that's, who cares if the shelter index goes up? If you've got a home that you bought years ago and you paid off the mortgage, you don't really care if the shelter index goes up. So it's not possible to find a measure of inflation that reflects everybody's situation. And so they've come up with a compromise, which is not very good. It probably understates the true rate of inflation, but we'll never be able to figure it out.
The Bank of Canada's next meeting is September 4th. Then the Fed meets September 17th and 18th. Are the markets expecting interest rate cuts at these meetings?
Yeah, both meetings. Of course, the Canada's already cut a couple of times, so that would be their third cut, I think. And the U.S. is yet to cut, but for sure they're going to cut either 25 or 50 basis points. So right now, on Thursday as we speak, the market is expecting a 25 basis point cut in the U.S., but that could easily go up to a 50 basis point cut if there's any change in the economic data that come out. For example, we had this week we had a revision. They do this every year, where the number of jobs that have been reported on a monthly basis was changed downwards by a dramatic amount, by over 800,000 jobs. So instead of the 220,000 on average that we think we've been getting, it's more like 175,000 on average. The reason that difference is there is because for the monthly ones, they do a call to a large number of employers, and they do a survey on the phone. But on the one that only comes out every 6 months and is about 6 months late, they look at actual employment insurance data. So they actually see how many people are collecting unemployment insurance and how many people are actually genuinely. So that's more of it's not a survey, that's an actual hard data. And that's the one. And so they do a preliminary around this time, and then around September of 2025, they do the final report. So if that's the case, if that new number that just came out is correct, and the employment gains have been much lower than what we thought, then the Federal Reserve may already be way behind the curve, and they may need to cut 50 basis points, and they may need to do it more on a more urgent basis. So we won't know for a while. We probably won't know till after the election, because if there is any kind of major weak data coming out, I suspect they would try to withhold it until after the election. But we can expect that that number that comes out in January, and that's way too far away for us to try and trade the market on, but that number in January show that the economy was probably weaker than we thought, and interest rates could come down quite a bit more, which is not necessarily going to be the big boost for the stock market and the housing market that people think.
Do interest rate cuts tend to get an economy back on its feet, or are cuts an indicator for concern?
So the problem is that people expect cuts to help the market and help the economy and help house prices, but they actually are usually a reflection of a weakness in the economy. So the cuts are happening because people that are the Federal Reserve, the Bank of Canada, or the Bank of England, they are recognizing that the economy is weak and likely to get weaker. So they want to cut rates in order to try and stimulate the economy. But there's not that much stimulus contained in cutting rates. The big stimulus that the big portion of the limited stimulus that cutting rates actually gives to the market and to the economy is through the housing market. So in traditional recessions, when they cut rates, and they usually towards the middle of a recession, they cut rates quite aggressively. That can kickstart a housing boom, which will pull the economy back out of recession into growth again. Because that's the biggest chunk of borrowing that the average household would ever do in their lifetime. So that has a big impact. But that housing, especially in Canada right now, that housing cycle chain is broken, and they could cut interest rates a lot. And if house prices are dropping and people can't get qualified for a mortgage, it might not work at all. So if the rates come fast and furious, and they instead of 25 at basis points at a time they do 50 or 100, then that's more likely a sign that we're in a recession and a bear market in stocks. So that wouldn't be necessarily a good time to get too optimistic. Waiting a little bit after the first rate cut and maybe even the second rate cut is if you look at the past data, turns out to be a pretty good strategy.
Edmonton and Calgary housing prices are moving higher even with significantly higher interest rates. What's causing the home price hikes and who's buying?
So the headline story, and I don't have any reason to doubt it, is that lots of people are moving to Edmonton and Calgary. They're leaving Toronto, they're leaving Vancouver. Anecdotally, I haven't seen too much of it, but certainly the houses are selling, and prices have gone up a lot in Calgary, a little bit in Edmonton, compared to going down in places like Toronto, for example. So there's also pretty good incomes in Edmonton, Calgary. There always has been pretty good incomes, though, and there might be some FOMO happening, fear of missing out. The realtors will say, when rates have come down, then there'll be a rush to buy houses, so you should get in before the first rate cut, and so there's a little bit of that going on as well. But yeah, it's actually a bit of a puzzle how strong the volumes have been. The prices haven't changed a whole lot, and I this is purely anecdotal, but I've watched several very expensive houses in our neighborhood just sit on the market, and they're not selling at all. There's nothing that is moving above $2.5 million, and it's been like that for a long time, like more than a year. So it's more in the $300,000-$400,000 range, which Edmonton and Calgary still has houses in that range. Vancouver and Toronto people would be shocked to hear that, but that's what's actually been moving. And there's a lot of new builds, and the traffic isn't too bad in Edmonton and Calgary yet, so people can afford to go out, find a nice place to live for $400,000, and maybe even get a garage. I don't know, and you can't really do that anywhere else. There are very few places in big cities in Canada or in anywhere else in North America, probably.
What's the latest on sales, inventory, and prices in the bubble housing markets, Vancouver and Toronto?
Well, the one that I just looked at recently was the condo market in Toronto, and it is absolutely shocking what's happening. There's a huge overhang of condos for sale. There's also probably an even bigger number of condos where people don't even bother listing them because they can see all the ones that are not selling already. But then on top of that, there's 20,000 new units coming up in the next couple of years that are under construction and close to being construction. It takes about 3 or 4 years for a big condo tower to be completed. So these ones have been under construction for a while now, and they're going to be finished soon. So the problem there is people bought them on the pre-construction, with 10 or 15% down, and when completion date comes, they have to come up with the balance, and they just aren't able to get financed. So this has become a big problem in Toronto, and similar in Vancouver. Although in Vancouver it's a little bit different. The condo market isn't quite as crazy there, but there is some weakness, and there's a lot of there's a record low number of sales in Vancouver, but I haven't seen prices coming down a lot yet. So people are kind of holding off, dropping their prices. But in Toronto, we're starting to see signs that the thing is really starting to crack, and it's of course these condos that are for sale. They're not that attractive. Most of them are under 700 square feet. They were bought by speculators and so-called investors. They were rented out. In most cases, the speculator or the investor was taking a loss per month, a small loss, $100, $200 a month. But now that interest rates are mortgages are renewing at higher interest rates, those losses have become more like $500 to $1,000 a month, which is going to force people to start to sell, even if they have to take a big cut, a big loss when they sell.
People were buying pre-sale condos and flipping them for profit. Has that coin flipped?
Yeah, I think that's over. I think that dream is gone. That bird has flown the coop. I don't think there's any chance of that. It's really an amazing story. Maybe somebody should write a book about it. But there was and we were warned about it in 2008, 2009 in the U.S. So we did the same thing. There was a lot of them got caught in that bubble, and when it burst. But of course, the scale is much bigger in Canada because Toronto still has, I think, over 200 cranes active, and Calgary has 34 cranes active. The U.S. cities never had that many high-rise buildings being built, so it's going to be crazy. And no, you can't. The whole idea of flipping those pre-construction assignments things was pretty dicey, even when the market was good. But now that the market is really gone dead, it's become pretty much impossible to do that, I think.
A large percentage of mortgages are up for renewal in 2024 and 25. Are the higher interest rates likely to cause problems when those mortgages are up for renewal?
They are. The numbers, so there's the variable rate mortgages, and then there's the 5-year fixed, and there's everything else too. There's different terms and stuff. But over the next 2 years, I think especially in 2025, there was a lot of stuff that was financed at 1.5–2% and when those come up for renewal, people are looking at 5 or 6%. They could switch to variable and maybe get a little bit lower rate, but I think we're looking at a double or even more in their monthly payments, depending on the amortization. Now, the government has changed the rules a little bit. They're allowing 30-year amortization, so maybe the person could get away with a little bit less than a double in their monthly payments. But yeah, it's going to cause a lot of trouble for sure. It is I checked on that statement by the Bank of Canada Governor Tiff Macklem, and it was in I'm just checking here, July 2020. He made the statement that said that rates were going to stay low for a long time, and then he reiterated it again in 2021 that rates were low and they were going to stay low. So that was right around the time between July 2020, when they were just coming out of COVID, and 2021, when the markets, people were really going crazy in 2021 in terms of buying properties. That's the cohort that is in the most trouble. Now, if they financed with a 5-year fixed mortgage, July 2020, that would be July 2025. You've got a lot of them coming up. So somewhere in the next year to 2 years, there's going to be a lot of people that maybe bought when rates are really low, that'll be finding it very difficult to handle the new. And will they be able to sell if they have to be forced to sell? I don't know. Some of them may decide to sell before. I think I've heard anecdotally that people are trying to sell now because they've got the renewal coming up in, say, a year from now, and they realize that we're not going to be able to handle it when it goes for renewal. So how much success they'll have in selling, I don't know. If they cut their prices enough, then they will sell, and they'll be able to get out of that obligation, but they probably won't like the price they get.
How many of the real estate professionals working today experienced a severe bear market in real estate?
Well, severe bear market. So the last bear market was in the 1990s, and it was from about 1990 to about 1994. It wasn't that severe. I think in Canada, I'm talking about, of course, I think it was like something like 20 or 30% over 4 years. But it was enough to really shake up a lot of people. There was a lot of people that were pushed out of the real estate business. A lot of people lost their homes. A lot of people suffered quite badly. But the thing was, it wasn't that terrible because we had 10 years previously in the early 1980s a really severe meltdown in the stock market and the real estate market because interest rates went to 20% there for a while. And so those two events were the last two that happened that anybody really got hurt in the real estate. So from about 1995 on, the people that have been in the business since then have seen nothing but rising markets with minor little setbacks. So that's 30 years. So the people that are in the real estate, there wouldn't be very many people that would have been in the market going back further than 30 years. So real estate is you do get sometimes some older people doing real estate, but it's you got to work nighttime, weekends, and it's hard on the family. So I suspect quite a few of those people, if they were that old to have been around in the 1990s and 1980s, they would have retired by now. So it's going to be a new experience for 95% of the people that are in the professionally working in the real estate industry. But I suspect they're already struggling because it's been a long time since some of them have had even one sale with this really low volume. Prices haven't come down much yet, but the volume has completely dried up.
If someone wants or needs to sell a home in the bubble cities, is it important to price the home right?
Well, I guess it depends on how badly you want to sell. I had a story about a friend of mine had inherited a cottage at a lake near Edmonton. The lakes near Edmonton are not like Muskoka; they're not as, but there's only a few. So if you got a lakefront property, it's usually considered pretty valuable. And but he got this cottage he wasn't using. He decided to sell it, and he talked to the realtor. And this was a few years ago, and the realtor said, "Well, yeah, people are listing them at around $400,000, and but it's pretty slow, and they're not really selling much." And my friend said, "Okay, well, listed at $320,000." And so it sold right away, of course. And about a year later, he ran into the realtor, and he said, "How are things going?" And the realtor said, "Oh, things are pretty slow. Nothing's much moving. In fact, in the last year, your cottage is the only one that sold." Anyway, there's a price at which they'll sell, and it's just hard for people to get over the psychological impact of taking a lower price. A lot of times, it's not even a loss. In this case, it wasn't a loss for him, but sometimes there's that anchor price and say, "Well, that guy over there, he got $1 million for that home, and I'm not taking less than that because my home is way better than that." So, but wouldn't it be better to have the situation resolved, even if you have to drop your price in that example from $1 million down to $880,000 or something? Much better to get it resolved and to move on rather than just sit and wait for. And in a market that maybe, if we go into a recession, it may be weak for a number of years, not just a number of months. In the U.S. in 2009, it was 4 years before the bottom. So it took 4 years to bottom. It was 38% on average was the price decline. So it gives you some idea. So the early bird gets the worm in the sense of if you have to jump your price a little bit lower to cut your price a little bit lower to get ahead of the crowd, then go for it. I think that would be my inclination anyway.
In markets, including real estate, does a decrease in volume precede a decrease in prices?
That's what the saying, the old saw, is that volume precedes price. So in the stock market, if volume dries up, usually that's a warning sign that something big is coming. Now, it can be either up or down. It doesn't necessarily have to be. Most people, I think that if volume dries up, that means the prices are about to drop, and that's probably the case. But occasionally, it means the opposite. In real estate, though, it's different because there's such a lot involved in making a trade. It's not like just pushing a button on a computer and the position is sold 5 seconds later. So you get into these standoffs, which I think is what we're in Toronto, in Vancouver, where the buyers are sensing that the prices are coming down and they're not willing to go up, and the sellers are not willing to drop their price. So it's basically the lack of volume indicates there's a gap in the view between the seller and the buyer. And it can be resolved two ways. The buyers can be panicked maybe by some kind of good news in the market or in the economy or something and jump their price up, get tired of waiting, or the sellers can be forced to come down, maybe by the lender, and maybe their mortgage comes up for renewal and they can't meet the qualifications and they're forced to sell. So my guess is it'll be resolved by the sellers having to drop their prices, but who knows? And it could go the other way too.
In down markets, there's always a story that provides an excuse for the low selling price. In reality, do those lower selling prices set new valuations in the marketplace?
Well, I think the realtor is required to tell people if a house if you got 5 identical houses and one of them sells for 20% less than what the other ones think that they're worth, the realtor's required to disclose that to the buyer, I think, in the rules. But they can also say, but that was a special situation. There was a divorce, and they were eager to get out of it and get over with it. And that's not the real price. But in reality, if the houses are identical or similar, that's the benchmark, and people have to deal with it. So I think that's sometimes why you see, like it's happening in China right now. It's kind of interesting what's happening in China. The Chinese government gets involved in this, and the developers were building all of these projects. And the Chinese government was restricting. You couldn't drop your price more than a tiny fraction of 1% in any 1 month by law, and they just lifted the restrictions in some of the big cities like Shenzhen. And so the developers who are dying to get rid of this inventory have dropped, I think I wrote down here, 37% drop in house prices in Shenzhen in one project. And of course, everybody hates that because the people that bought just say a year ago or 6 months ago paid quite a bit more. If they'd only waited till the prices dropped, they would have gotten a much lower price. So that affects everybody. And that's why the government wasn't allowing it. But now they've opened it up and they started to allow it. So that's the sort of thing that can impact a lot of people in a big way. Now, we don't have any restrictions on how much developers can drop their prices, but they're reluctant to drop them because, again, they've got the situation where they're in phase 3 and the people in phase 1 and phase 2 just paid a really high price, and now they're going to cut the price in phase 3 and undercut all those people. But that's the reality. Sometimes it has to happen that way.
Are retail sales in Canada being supported with more consumer debt?
Well, I think the Canadian Tire has had 3 or 4 quarters in a row where they've said that the consumer is struggling. Now, the latest report, it was quite negative, and yet the stock rallied. So I'm not quite sure. I'm a little puzzled as to what the sequencing is there. But in general, people are, as we know, governments and banks and everybody, Bank of Canada, the regulators of the banks, all of them are counting on the fact that, and it's a fact, that in the past, Canadians have always paid their mortgages. There's been very few defaults. Like the default rate is 0.1%, and in the really bad recessions, it goes up to 0.3% or something like that. It never gets up to something like 1 or 2%, and which would be scary. But so in order to hang on to their house, people cut out vacations, they cut out trips to Canadian Tire, they cut out restaurant meals, they cut out everything. And we haven't seen a lot of that yet, though. One place that's really started to show up is in auto finance, where people are rapidly, there's a large number of people that have started to get into trouble on their car payments because I think they feel like, you know, if my car gets repossessed, that's not a big deal. But if I lose my house, that is a big deal. So you're starting to see it in the automobile sector. Whether it'll spread to the housing sector, we don't know. There's very little data that show that Canadians would walk away from their homes. So we don't know. Oh, there's another one of the biggest an owner of one of the largest chains of bankruptcy and solvency franchises in Ontario, Doug Hoyes. He does a podcast, and he puts out quite a bit of information. And he mentioned in recent times that they're starting to see for the first time people coming in to talk about whether they need to bankruptcy or consumer proposal, the people that actually own a home. In the past, it was pretty much always just renters that got into trouble. But this time it looks like the homeowners are starting to come in. Now, that doesn't mean they're going to walk away from their home. It just means they've gotten into financial difficulty and they've gone to have a discussion with the bankruptcy trustee.
What percentage of people invest in the stock market, and is it enough that if the stock market is bullish, it will cause the real estate market to be bullish?
It changes from city to city. I think I think most people that are looking at getting into the housing market don't have a lot in the stock market. I mean, the thing is that the new money is most of the new money in the housing market comes from young people that are buying for the first time. They're moving from rental status to ownership status, or mortgage indebted status, would more accurately, with some help from the bank of mom and dad. That's new money that's coming. That's new money created when the bank approves the mortgage and makes the mortgage credit available, and that's new debt for the young couple, and that's new money going to the housing market. The rest of the thing is mostly people that own homes selling and buying. Maybe they're upgrading from a $1 million house to a $2 million house in Vancouver or Toronto, or $2 million to $3 million. So they may, if the stock market's doing really poorly, that second, like the upgrade market, they may feel good, and they may have some stocks that have done really well, and that encourages them to think about upgrading. So that if the stock market's doing poorly, the upgrade people don't need to upgrade. They could just hang on where they are for a while. So that may have an impact there. But for the new first-time buyers, I don't think the stock market has much impact at all. It might have an impact on second homes, like homes at the lake cottage or the ski hill. But for the main home, I don't think it has a big impact because of new money. The other big source of new money, though, I should mention, is foreign money coming in from places like China. And with what's going on in China with their housing bubble bursting, I think the new money coming in for China could have a big impact on Canadian real estate in a negative way because it's obviously going to dry up. If they're losing money in their property in China, they're not likely to be bringing money to Vancouver as much anyway.
In Vancouver, we're seeing a lot of Teslas, but now also a lot of electric vehicles from established automakers. Do you think we're still in the early stages of the electric vehicle boom?
Oh, for sure. I mean, in China, the new vehicle sales is up to now. What they call new electric vehicles includes hybrids, right, in China. So I wish they didn't do that, but they do. So BYD sells a lot of hybrids. So, but with that caveat, I think the latest data are showing that it's as much as 50% of all new sales are in the electric category, whether it's all electric or and in North America we're like, I don't even think we're at 10% yet. So we've got a long way to go, but it's headed that way. The problem with non-Tesla cars is some people are coming out with some really good offerings. I just saw a report today that BMW is now outselling Tesla for the first time in Germany. So there are some good cars. Some of the Koreans have, I think Hyundai, which does Ioniq, has a good offering. GM and Ford are still struggling to get their act together. Stellantis, as far as I know, doesn't have much going on at all. Volkswagen has an offering, which is interesting. They've done the iconic Volkswagen van that people had in the 60s. They've got an electric version of that now. But the big obstacle is charging. So one of the big things holding back people from buying electric is they're worried about range. They call it range anxiety. So the Tesla has done a phenomenal job of providing superchargers everywhere you want to go. Like, there's just no problem. Even in fairly remote parts of northern Canada, like in BC, there's a supercharger every 1 or 2 hours. So it's not a problem. And of course, I'm sure it's much denser in the U.S. So now some of the car makers have signed a deal to start getting access to Tesla supercharger network, which is a good solution, I think. So we'll start to see more and more non-Tesla cars as soon as people are able to get that charging, access to good charging. And it's almost there, but it's not quite there yet. So I hope there's lots and lots of offerings because we don't want Tesla to get all the business. We want other people to get it on as well. Toyota, by the way, has just done nothing on the electric. It's just absolutely shocking. They had for years they had the best-selling hybrid long before anybody else had one, and they just completely dropped the ball. So they're working on a hydrogen car, but they will come up with something in electric, I think. But whether it might be too late for them, I don't know.
In China, BYD just showcased a 1,200 horsepower electric Lamborghini-like sports car. Established automakers and Tesla versus electric vehicles built in China. What do you see ahead?
Yeah, well, I think those are publicity stunts to some degree. But the big thing for China is they are making phenomenally good electric vehicles, and this is why Biden is talking about 100% tariff on Chinese-made cars. Europe has just put a 9% additional tariff on Teslas imported into Europe. Now, other manufacturers like BYD have been hit with a 20 or 22% tariff, so it's not as bad as Tesla's getting off a little bit lighter, probably because they have a factory in Berlin. Eventually, all these car makers from China will probably open up factories in North America and Europe in order to be able to sell into those markets. But the quality is great, and the price is much lower than what the Ford and GM can do in North America. So it's going to be, I think, could very well be the bankruptcy of the big U.S. automakers, Ford and GM, Stellantis. They can't compete, and they really are so far behind now that it's going to be very difficult for them to find the money. They have to get a bunch of capital, either borrow it or sell shares, in order to finance the building of a real platform that would offer electric cars. And most of the announcements recently have been they've cut back on their manufacturing of electric vehicles, so they may have just decided to run out the clock with their existing models until they can't sell any anymore, hoping that people stick with internal combustion engine vehicles longer than. But I don't think that's a very short term, maybe 5 or 10 years at the most. It won't last much longer than that, I don't think.
Looks like Tesla has an updated Model S for 2025. Have you seen it?
I've heard rumors about it, but I haven't. There aren't any out on the road yet, I'm pretty sure. I bought my Model S in 2021, and it's been quite a while. So that was November 2021. So I think that model came out earlier in that year, about March or something. So in March of 2025, it'll be 4 years. That's probably time, but I don't expect a huge change. There's something happening though that, and I didn't get in on this, but there's a new hardware called Hardware 4, and it's designed to be better to accommodate the fully self-driving software and with a much bigger computer. And it involves different cameras, different computer, different wiring. And so they can't just take my car and retrofit it with Hardware 4. So that's going to be hard because I don't want to buy another Tesla. I'm on my third Tesla. I don't want to buy another. But we'll see what happens because I'm actually really starting to enjoy the fully self-driving. So it's finally working to the point where you can drive it with hands off. You don't have to have your hands on the wheel anymore the way you used to. It now judges your attention span based on your eyes. So there's a camera that checks your eyes, and as long as you're watching the road in front of you, you don't have to have your hands on the wheel. It makes almost all the decisions correctly. You still have to watch. There's a few things that sometimes it doesn't get right, like the speed limits sometimes in the school zones and construction zones and stuff like that. You have to really watch. But other than that, it'll take you from, you just dial in your destination into the navigation bar and it'll take you right to the door. So I didn't actually think I was going to like that as much as I am, but it's actually makes quite a big difference, quite a bit more pleasant drive and not having to make all the decisions all the time.
Is distance still the big concern for potential electric vehicle buyers?
I think it is, but once they get used to it, I mean, people say, well, I'll buy one when it's 700 kilometer range. Well, the thing is that nobody goes 700 kilometers without stopping. So as long as there's where it seems to be settling out now is around 200 kilometers. So 2 hours, 200 kilometers on the highway, maybe 300 kilometers is a nice, time. A nice time to stop and stretch your legs, go to the bathroom, maybe get a coffee. And as long as there's a spot that you can do, the computer tells you where you have to stop and how often you have to stop and all that. You don't have to search or anything. It just automatically tells you where you, and if you're using full self-driving, it'll drive you right to the spot where you have to stop. So what people find is it actually makes more sense to stop after 2 or 3 hours. And because what you can do then is you can only take on, if you only take on 100 or 200 kilometers of new charge, it can take as little as 12 minutes with the new more powerful superchargers that they have. Sometimes people don't even get out of their cars. They just plug it in, get out, get back in, wait 12 minutes, and then off they go. So, and that's because when the battery is, when you're not trying to fill the battery completely full, it's very fast. When you get up to 400 kilometer range and you're trying to get up to 600, then it starts to slow down because of the way the chemistry and the power works. So it's better to run it down to 100 or 150 and then bump it up to 350, go to the next place, and then do it again, than to run it right down to empty and then try and get 600 kilometers back into the battery. Unless you're at home, you can do it overnight, and then of course you can do that. But so once people get their heads around that, and of course in the city, most of the time you don't need to. You need to do it once every 3 or 4 days or once a week in my case. Don't drive that much. So it's really not as big an issue as people think it is. It's actually becomes a fairly minor thing. You do have to plan ahead, though. If you're going to want to get going early in the next morning at 7 a.m. and you forget to plug it in overnight, then you're going to be delayed for a while you get your charge. But other than that, it's not as big a deal as people think it is.
Hilliard, where can people follow you?
So on X, formerly Twitter, I'm quite active, HMACBE, and the books are available in the second edition's got the red cover, and the first edition's got the black and white cover, and they're available on at the different ebooks like Amazon and Kindle and Kobo and that sort of thing, and also in most bookstores as well. So and if you go on Twitter on Fridays, you can get a link to my weekend note, and then when you get to the link, you can sign up if you want with your email, and we'll send it directly to your inbox in your email rather than having to look for it on Twitter. And it's usually the weekend notes are put out every week, and they're not always on the housing bubble or electric cars. They're on lots of different topics related to finance, markets, and economics. And this week's is going to be on the what happens to the U.S. economy and the U.S. market depending on who wins the election in November. So stuff like that.
Hilliard, thank you so much for being on This Week in Money.
Thank you.
My guest has been Hilliard MacBeth, his website, MacBeth.McLeodPartners.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.